Of course, we're talking about buying and selling shares in publicly listed corporations. There are different types of corporations, as we're well aware. If we're talking about a private limited company, then you have less freedom to buy shares from those ones, because the shares in a private limited company, they may be there, but they're not open to the public. So if you want to become a shareholder in a private limited company, you need to be invited in. Either somebody who's already a shareholder needs to discuss with the company about transferring their shares to you, or the company invites you to become a shareholder because they're issuing additional shares or they're doing something along those lines. A public corporation, which would be a PLC, is allowed to offer its shares to the public, meaning that it becomes an issue of negotiation with the individual shareholders about passing on their shares to you, and they don't need to involve or inform the company, at least at the level of negotiation, about their decision to get rid of their shares. Why do you think companies that are public may want to be listed in the stock market additionally? Because you have much wider access to people if you're on the stock market. If you're a public company but you're not listed in the stock market, it might not be obvious to everybody who is a shareholder and how they can obtain shares. The good thing about the stock market itself is that it provides a transparent and open marketplace. So you can see who has shares, you can see what the prices are for those shares, and it is very easy to engage in these transactions because the stock market acts as a clearing place, meaning that they handle the money, they handle the administrative aspects of the transaction, but they also provide transparency as to where these shares are, which shares are available, and at which prices they are available. That's why the majority of corporations actually that are public wish to be part of a stock market, so they have access to all these wider mechanisms that allow more investors to come in. And the way people make money out of shares, sometimes you buy some shares because you think there's good potential for dividends at the end of the day, or because you think the price might go up, so you sell them to somebody else a little bit later after you bought them. If anything, I would imagine more people seek to make money out of transactions on the shares as opposed to holding them for a long period of time and making money out of the dividends. I would imagine that if you're a shareholder in a private limited company, you seek to make money out of dividends primarily, but if you're a shareholder in a public listed one, then the transactional value is probably more important to you. Now, in order to become part of the stock market, you need to go through a lengthy process, during which the corporation effectively has to spill its guts about its finances, the way it does business, its aspirations, quite a lot of things. So already, when you're transitioning from a private limited company to a public limited company, you need to release a great deal of information, not just the first time that you make the change of status, but also on an annual basis, you need to make returns to Companies House. This gets way, way bigger if you're joining a stock market. So to be allowed to float in a stock market, you need to create a prospectus, as they call it, which is a very, very detailed magazine, effectively, that presents the corporation. It presents the shares and the rights that attach to those shares and all the contractual and regulatory documentation that comes with it. This is the price that you need to pay for access to these markets. So if you want to keep things private and secret, then probably listing in a stock market is not a great idea. And as I said, this isn't a one-off. It isn't that you only give this information on your initial public offer, but you need to renew this information on an annual basis because then you need to disclose to the regulator and to the general public a great deal of additional information. A lot of the exemptions from giving them accounts and information and strategies and so on that apply for small corporations, the private ones, or perhaps small and medium public ones, do not apply for the ones that are in the stock market. So if you're in the stock market, you're obligated for the whole range of disclosure as described in various parts of the law, which is all for the best because, as we said, you don't buy a pig in a sack. You need to be able to see what it is that you're buying. And the only way that you can participate effectively in this process is if you have enough information to allow you to make informed choices. This doesn't mean to say that everybody makes the right choice. People still buy the wrong stuff and they lose money in the stock market. That's why every time you consider any investment that contains tradable assets like shares, it will say there's a risk of you losing your money. If you want to be sure that you're not going to lose your money, then pick a savings product that pays you a certain amount of interest, but there's no chance that your capital is going to be affected. For everything else, you see this disclosure at the bottom of the ad that says capital at risk. You might get back more money than the ones you put initially, as you hope, or you might get less money than you initially hope for. So you need to do this carefully. This is the sort of background understanding of what happens if one joins the stock market and the reasons why all this disclosure is mandated. It is part of the job of the state to ensure that people don't get into trouble by getting scammed. And the more people that are getting scammed, the more of a problem it becomes. And if large amounts of people end up getting scammed, then this has systemic effects. Imagine what happens if everybody loses their money in the stock market at the same time. This can have debilitating effects on the whole economy, right? So the government has an inbuilt incentive to protect people from getting scammed, which sounds weird because there are a lot of scams in the stock market. And what I personally find quite baffling is that while we have set systems for the disclosure of information, and there's quite close monitoring of domestic corporations that seek to enter into the stock market, there seems to be a tolerance for unverified information from foreign corporations that seek to join a stock market. I hope everybody knows that you don't need to be from this jurisdiction to float in the stock market. This has to do with the rules of the stock market. A lot of the stock markets allow corporations that are registered in a different country to actually have a presence in the stock market. That's why corporations from all over the world, they will go and float in New York, and they're listed in NASDAQ and Dow Jones and all of that stuff, right? And so you can have foreign corporations in an American exchange, you can have foreign corporations in the London Stock Exchange. Very frequently, people who invested in those foreign corporations in the stock markets lose money. And one of the reasons is that there seems to be some opportunity for incorrect information or not as transparent information to make it in through the approval process and into the stock market for these foreign corporations. Which brings me to the reason I'm telling you all this. I find it very weird that the big Chinese online retailers are seeking listings in Western stock exchanges. So you've got Shine, who's trying to join a stock exchange. They're considering New York. They're also considering London. Quite a few other big Chinese corporations from the retail domain that have joined stock markets in the past. And quite a few of those have done very, very badly because they were lying about their profitability and their prospects, which caused the shares to go very, very high. And when it got discovered that the finances are not actually matching with expectations, these shares tanked. So if you happen to be the person that bought the share when it was very expensive and now you're selling it and it's worth nothing, you lose a great deal of money. So that's something to think about. If we're talking about a regulatory environment that's got its purpose is protection of the financial services consumer and has all these rules in place, how come it seems that there's some flexibility on this when we're talking about corporations that are coming from overseas? And when the stock markets are competing for attractiveness and say, London's doing very well because it attracted all these foreign corporations, or New York is doing very well and London isn't because they prefer to go there, maybe getting a lot of these isn't a sign of success. Maybe it just means that the regulators aren't as thorough in the checks and they do actually allow dodgy corporations to join the stock market. So I wouldn't follow with the logic of the newspapers recently, which has been, London is losing in competitiveness because most of the big listings take place overseas. Maybe these are big listings we don't want. So you cannot really judge the effectiveness of a stock market by the amount I mean, of course, the amount of activity is important, but you cannot choose the success or failure of a stock market on the basis of how many big listings, new listings it gets, because it could be that there's a lot of dodgy corporations that have been, unable to list anywhere else, and they're all coming here because your standards are looser. This is not a sign of success. My projection might be over-optimistic, but I'm not lying about my existing numbers. If I turned over 5,000 and I can show you the documents for this, that's fine. So there's a different thing saying I turned over 10 when I actually only turned over 5, and then I base my projections on that. Now, if I have very optimistic projections for the future, then it's up to you to assess whether you think this is justifiable in the circumstances. What happened with WeWork, with the first time they tried to list, is that they came up with these valuations, and everybody was like, look, well, okay, this is an interesting idea, but this is a very kind of easily replicable idea. You guys don't kind of own the concept. So everybody else can do the same thing you're doing. So soon you're going to face a great deal of competition. So we don't think this is going to work out. And then, it caused the whole crisis. Like eventually they managed, but with different valuations. And then the pandemic hit, and then, the realities of the business were a little bit different, and they couldn't actually maintain profitability. That's why they got in trouble in certain jurisdictions. Every jurisdiction has its own, at least one, but you can have multiple. For instance, London has two. One is the London Stock Exchange, which is the main market, and the other one is the alternative investment market. It used to have more, but then the others shut down. There used to be a third one, but then that didn't complete. Usually, the bigger the jurisdiction, the more the stock markets, but everybody has one. Yeah, even kind of terrible countries have one because they've got public listed corporations. Setting up a regulated stock exchange is a very complicated process. Setting up even a cryptocurrency exchange is now a complicated business, but setting up a regulated exchange for publicly listed corporations that the state controls access to this, then that is a very big deal. But yeah, you can have the bigger your country and the bigger the range of industries that this country can support and the amount of investment that is available, then you can have multiple stock markets. In China, they've got multiple. But there is no such thing as a global stock market. And you couldn't have one because they're regulated by the systems within the country, right? So it would have been very difficult to have somebody that is outside of jurisdiction that serves this purpose for the entire world. So for instance, the regulatory environment that we've got in the UK is trying to do a number of things at the same time because the role of the state is to control what is happening in markets and what is happening in the economy more broadly. So some aspects of the system are controlling the supply of money and the availability of money and keeping an eye on interest rates, exchange rates, and all of that stuff, which is the core job of the state. So usually the country's central bank does this. In our case here, this is the Bank of England. The norm in Western jurisdictions is that you have a bank, the central bank, that keeps track of the monetary supply and exchange rates and interest rates independently of the wishes of politicians. This is deemed to be a good idea because nobody trusts the politicians not to fiddle with things for their own political purposes. For instance, inflation is a bad thing because inflation eats away at the value of money. It creates all sorts of distortions. If you're coming towards an election, the politicians might be willing to increase everybody's wages to make everybody feel better, right? Because we're coming close to an election. So they might want to allow inflation to go higher than it normally is by increasing all these things, which might be a bad thing for the performance of the economy further down the line. So the logic has been that if you want control over these fundamental aspects of the economy, you better give them to somebody who knows what they're doing and they don't operate on the basis of a particular electoral framework. I mean, Turkey is a good example of what happens to you when the politicians meddle with monetary policy. They've done poorly. right? Because they don't really have independent decision-making as regards these things. So even though they technically have an independent central bank, this doesn't work very well for them. So what happens in Europe? The European Central Bank takes care of these things in the Eurozone, the Bank of England here, the Federal Reserve in the US. And they don't ask the politicians for permission on the decisions that they take. The part that belongs to the government, which is here the Treasury or like a Ministry of Finance or something like this in other jurisdictions, they do have some input in what is happening in the country. Part of what they do is what is here the Financial Conduct Authority, which regulates the financial sector. Because somebody needs to be in charge from the part of the government with how private banks and financial institutions operate so they don't start doing dangerous things that unbalance the economy. So this is different. This is how the actual banking and financial system works. This is different from the value of sterling and interest rates and monetary supply and all of that stuff that the central bank does. So the Financial Conduct Authority that is doing this job here is also independent from politicians, even though it's a state authority. But its job is to make sure that the system is adequately operational, and if they discover risks developing in the system, some banks are beginning to do dangerous things and they're in danger of kind of going bankrupt or whatever, then they have the mechanisms to stop some of that stuff from happening. Now, they don't always succeed because we have kind of repeat financial crisis. They don't do particularly well all of the time, but at least the systems are there. Now, one of the debates have been going around for decades is whether it's actually a good idea to take all these various tasks that have to do with controlling the economy and its operations and segregate them across different authorities, or whether you should have a single regulator looking at everything. Unfortunately, there's no answer to this, because when you have a single regulator, there's just too many things to look at, so they don't do a particularly good job. If you've got many different authorities, again, the authorities don't talk to each other efficiently, so then they cannot coordinate and do a particularly good job. So no matter what you do, there are always going to be problems in there. But that's part of how this game is played. And as I've told you in the past, it doesn't really matter how you organize things. You're always going to have crisis one way or the other, because that is inherent on an open market system. Things go well, and then they don't, and then you have a crisis, and then some things go bust, and then some new things come around. So if you are happy to live in a capitalist economy, then you need to accept that there's a cyclical thing where you got, sometimes it's good, sometimes you get crisis. Now, as regards having the politicians not fiddle with the economy, of course the politicians will inevitably fiddle with the economy. We had a budget recently when they did just that, fiddled with the economy. And the way that they fiddled with it is by playing around with the tax burden. Because, of course, they're going close to an election, so they want to reduce taxes, so people feel that they've got more money available, so they feel more positive. And the narrative is always like, we lowered your taxes. If you vote for the others to come in instead of us, they're going to raise your taxes. We gave you money. These guys are going to take it away. Sometimes it works. Sometimes it doesn't. So we've got all those rules, right? So we've got all those rules as to who can join a stock market and who can have access to the public. And we've got a very elaborate system as to how the government tries to control or influence these things to make sure that it's safe for everybody. We then have specific instances where people do scammy things. Tell me what you think about this. You go to the gym. Who goes to the gym in here? Who pays for a subscription but never goes to the gym? Yeah, exactly. Yeah, that's it. And the people exercising next to you, because it's so tightly packed, you can hear their conversation. And they're going how lucky they are to have bought some shares in their app today because they think that business is going to do so great. The people on the other side of you work in the same firm, and they're discussing that their firm has received interest from Google, and Google's going to buy them out. And they're thinking, we're going to be rich because when people find out about this, the share price is going to go through the roof. So when you're leaving the gym, pick up your phone, you go to your trading app, and you're going to go, okay, these dudes just today, they were saying that they bought those shares in that business. I'm going to buy some because if these guys are so excited, they look like they know what they're talking about. So let's buy some and see what happens. And then also let's buy, if these guys are going to get bought by Google, they're going to make a killing. So let's get in there and buy some of those shares that the other guys were talking. A few weeks down the line, the takeover bid is announced for the company. Google is giving a price in excess of the listed. The rumors had spread. The price had gone through the roof anyway. So you're getting like a 70% return on the shares that you got from the one that's getting taken over by Google. The other one was also a good suggestion. So you made like a good 15, 20% on the other shares as well. So you're feeling really pleased with yourself. Yeah. Do you think you've done anything wrong? That would be a sad way. You want to go to prison, just like going to prison for this is just silly. Yeah, going to prison for white-collar crime is really sad. They're going to beat you up badly. So an individual who has information as an insider is guilty of insider dealing if in the circumstances mentioned there, he deals in securities that are price-affected securities in relation to the information. Right. Now, what is Section 3? The circumstances are the acquisition or disposal in a regulated market and blah, 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 blah. Right. Now, you need to have information in these circumstances, and the information needs to relate to securities and their prices. You need to transact, of course, but who classes as an insider? You're an insider if you work at the place or if you have engagement with that business. So that's why you have access to non-public information. But also, if you encourage another person to deal in these securities, you are responsible. Equally, if you disclose the information, even if you have done it unintentionally, then you are also guilty of this. And interestingly, the recipient of the information and the giver of the information are equally guilty. You have the opportunity to do something inappropriate, right? It doesn't matter. You have to go do it. Like somebody leaves their keys in the car, you're just going to steal it because they've done something stupid. Well, there we go. Cigarettes in prison. Or if you prefer vapes, I don't know, what you guys have these days. Yes. Yeah, there we go. So I know a lot of corner shops that the owner should be spending some time in prison because all the kids come out of school and they go straight and buy vapes, and that's never a problem. Yeah, that's fine. Don't do anything with it. Yes, in the same way that if one of you forgets the phone, I'm not gonna put it in the pocket and run off, right? And a significant amount, or they might not catch you if what you've done is minor. You've still committed the offense, but they might not catch you, in the same way that the police will never catch the person that stole your bike, stole your Amazon delivery, broke your window and took your computer, or, ran over your pets, or beat you up coming out of the club, and all the rest of the stuff that happens every day that the police couldn't care less about prosecuting people about. So yeah, you might get away with it. But the way people get caught is because normally these are significant transactions. That either people transact for themselves, so they know that something's going down, and then they position themselves against this. So the people inside the business, they know that somebody's approaching them for a takeover, and they go buy some additional shares themselves before the price shoots up. Yeah? So this becomes obvious. Or you make a significant transaction in the market that is inexplicable, it makes you a large amount or a significant profit, and then somebody comes and asks questions, how come did you do this? And if you cannot defend that question, they will start investigating, and then they might kind of connect the dots and you're going to be prosecuted. You have to be prosecuted, right? So it's not like the police declares that you're guilty of insider trading and they send you in prison. They will prosecute you. So it's the job of the CPS to actually make a case against you, and they will have to gather the evidence. Say that you invested for the Lord and you were going to give the process to the church.
Yeah.
You know who are the best scammers? So yeah, that's probably not an excellent example. Or the guy, wasn't this guy that scammed so many people, this guy, TikTok influencer, right? That went around to various quite religious Muslim communities, and he was telling them that they should invest with him because as a Muslim, he is an ethical person and so on, and he knows their interests and he's part of the community, and he just told everybody. The person who has the information from an inside source is an insider and is not allowed to do any transactions for private gain. If they pass on this information to somebody else, either intentionally or unintentionally, they're committing an offense. If the person who received the information carries out the transaction, then they're also committing an offense. If you have arrived at this information through your own research and you're the only one that knows it, then you're not being penalized. That's fine. So you don't get penalized for being a clever investor. You're penalized if you're using inside information. So the people at the gym that they were talking about, this would be a good investment. They're looking at it from the outside. The fact that you heard them talking about it and you got the idea doesn't mean that you're committing an offense, because this doesn't meet the definition of the offense. What they were talking about was not inside information. And they are the ones breaching confidentiality by talking about this in an open space. If they called you in for a meeting and they asked you to sign a non-disclosure agreement, and then you went and transacted, then you would be breaching your non-disclosure agreement, but that is a civil offense, so they would sue you for breach of contract, right? There is no other reason, especially if they're talking about it in public. I mean, you get information from whichever way you get it. So you're sitting around, you could make a living out of this, sitting around in private members clubs, pretending to read the newspaper and listening to conversations around so you get some stock market tips. So long as you don't get inside information, then you're going to be safe. Yeah, people are talking about this in an open forum. Now, in the same way, somebody could have a podcast where they're talking about these things, or, put stuff online or write a blog, right? Maybe not a lot of people know about this, but you noticed it, you got some good tips, you made money. Or you did your own research. So when they come asking, why did you make a bet in that company at this amount, at this random point in time? And your answer is, I am a market analyst and I have spent ages looking at potential acquisition targets for Google because these guys are working on this technology that Google is actively looking to increase capacity. So I thought they will, they're doing something interesting, so they might be bought by somebody sooner or later. And that's why I positioned myself, and I got lucky and they got bought very quickly. Then nobody's going to say you're not allowed to do good work on your own. But if the circumstances are suspicious, then you're going to get in trouble. Yeah. But most of the time, guys, the people who get in trouble for insider trading are not kind of random people who overheard the discussions in the gym or in the toilets or whatever. Yeah. They are usually spouses, family members, business associates. So there is an obvious connection. So there's a connection with the person that was in control of the inside information, and no reason why these people would, out of the blue, make that investment. Yeah? But people go away for this all the time. Now, if you were doing something else, if, say, there is no takeover bid, but you think, okay, these guys are developing AI software, and Google is looking for people who are doing this. So why don't I buy some shares in this company and then spread a rumor online through my social media channels that Google is interested in buying that company? Or tweet something, and then Elon Musk, who's an idiot, is going to see it and retweet it, and then the whole world's going to see it, and it's going to create the impression that these guys are going to go, Google's going to go buy that company, at which point I sell my shares because the shares have shot up in value. I make all that money, and Then I leave. When it turns out that Google says, actually, we're not interested in this, we're not going to do it, who the hell knows any? It wasn't real anyway. So, do you think that if I was doing this, if I was creating an impression and then I positioned myself on the basis of that impression, would I be doing anything wrong? This wasn't real information. I didn't get it from anybody. So why am I committing an offense? You could say that I'm selling private tuition and I put on the website that says I'm the most highly rated lecturer in, I provide no evidence for it. It's people see it, they think, oh, we might want to pay this guy for tuition. So if for it to be misrepresentation, somebody needs to be contracting with you. They're not contracting with me. So if I create, I want to drive students to the university, so then I have the social media accounts where I say lots of great stuff that are all made up, right? They're not contracting with me, so nobody's going to sue me for misrepresentation because there's no resulting agreement. So why is it against the law? But we've got things about market abuse that are in the Financial Services and Markets Act of 2000 and various other new things that are coming around. So interestingly, in the Financial Services Act of 2012, we do have specific provisions on misleading statements. There is no independent reason why these things are wrong. I mean, people just talk shit all the time, right? Sometimes it has consequences, sometimes it does not. Sometimes it has very severe consequences. Look at Trump. He's built an entire career out of talking shit. He even became president, and he's going to become president again. Creating false impressions is not new, and it's not necessarily criminal. You want to see false impressions, turn on GB News, right? There's an entire news channel built around fake news and nonsense. And kind of misrepresenting reality and so on is what kind of a lot of people do for a living. That's why if you don't find a specific reason, you cannot say that something is wrong. Now, if somebody was contracting with you and they're lying to you, then misrepresentation is the best avenue. And if they're doing it on purpose, then you have fraudulent misrepresentation as well, which might have criminal consequences too. But this stuff about creating an impression in the markets in order to position yourself so you make a profit are a crime because you've got specific legislation. So you've got all these rules there about what constitutes market abuse, and there are criminal sanctions attached to this. Now, why do you think that there are criminal sanctions for this rather than just penalties and fines and stuff like that? Because normally rich people don't like going to prison. Yeah? So if you make something a criminal offense, and that's why I told you a lot of the directors' duties stuff, they've got some criminal sanctions attached if they get it wrong. It's to help people pay attention. Because if you tell people, if you create a false impression in a market, then you might be caught and you might be fined, and the fine can be up to a maximum of £500,000. What does that mean? It means that you can do it profitably so long as you gain more than what is the maximum fine. Yeah? So that's really the disincentive. It's like telling people, if you're caught breaching sanctions and delivering oil to Yemen or whatever it is, or Iran, then we're going to fine you 1% of your profit or your turnover. You still keep 99% of your profit. So how is that a disincentive? Yeah? So if you just limit the penalties to a financial amount that is not meaningful, people are going to continue to do it. If you attach criminal sanctions, then, because people don't enjoy going to prison, then they might not do it. So the disincentive is higher. So that's why all of this stuff is, in fact, criminalized and on a variety of jurisdictions. So if you ever go through the lecture notes, you're going to see that they're both kind of domestic UK-based offenses for this, but also there are lots of them in the EU, lots of them in the US, and people get caught all the time. And why do people get caught all the time if they know that there are rules there? For the same reason people commit crimes all the time anyway. Yeah, it's human nature. Because people think they're not going to get caught. Is a medium-sized company that do fitness, beauty, alternative remedies, good for them. Jim Beam is the accountant. He has a bit of a drink and drag problem. I'm guessing if you're an accountant, you need something to spice up your life. So during a break at his AA meeting, he mentions to one of the members of the group, Holly Hoods, that he would not be attending the meeting the following week, and she's worried that he might start drinking again. So she asks him about it. And he says that they're under great pressure at work because there's a takeover by one of the other fitness clubs and so on. This is not a public announcement. Yeah? So Holly decides to spend that money instead of drugs on shares. So she goes and spends £10,000 of shares in Hot Stuff PLC. Jim, because he's trying to generate some cash as well, he tells his stockbroker to sell all his shares. You're being asked to discuss if people have done anything wrong here. So why are we saying that Jim Beam is an insider? He doesn't work well. Is he actually? Yes, he's the accountant. No. Being the accountant, it could be that he works inside, but it could be that he's an external. If he doesn't work inside and he's the external accountant, the auditor, well, the accountant could be somebody that works inside, but it also could be an external contractor that's doing their accounts. Do you think it matters in their classification as insider? In both cases, it's an insider. You don't have to be an employee. You just need to know stuff on account of your work engagement that are not in the public domain, right? This takeover thing is not in the public domain. So if he's an insider and passes on the information to her, then that makes her an insider as well. They're going to prosecute her. So let's see. Would she be able to use any of the defenses in the Act? So this is Section 52 of the Criminal Justice Act of 93. Could Jim say that he's not guilty of insider trading because he was not expected, he didn't think the information is price sensitive? Well, it is price sensitive. It's about takeover and nobody knows about it yet. Do you think Holly would have done what she did regardless of whether she got this information or not? That's unlikely. Could he say that he did not at the time expect any person because of the disclosure to deal in securities? It will be for her, but the things what happens to her and what happens to Jim are different things, yeah? Because we need to figure out whether Jim would be liable for releasing this information, whether he would be committing the offense or not. So one of the defenses is this, that the disclosure of the information, when he disclosed the information, he did not expect any person because of the disclosure to deal in securities in the circumstances. But this wouldn't come into this. It means that your firm might have a breach of contract claim against you or dismiss you because you breached the NDA. But it wouldn't affect the insider dealing discussion. Well, in an AA meeting, they try to support each other to come out of an addiction. So clearly, in this context, people are speaking about things that might be highly personal, right? That they wouldn't expect them to be disclosed outside. So I'm thinking that because there is a confidentiality obligation or expectation out of the context in which they find themselves, that he could legitimately say he didn't expect anybody in that meeting to use any information that comes out of that meeting. Now, if the guy is in a meeting and he says, I drink because I'm cheating on my wife and I feel guilty about it, you wouldn't really expect one of the other people who are in the meeting to ring up his wife and say, guess what? We figured out why Jim drinks. You know the secretary? Yep. So all these disclosures that happen within these contexts would be hugely problematic for people if they were released in the outside world. And I think this is kind of part and parcel of participating in that process, an expectation of confidentiality. So even if it's not contractual, because he's not talking to his lawyer, he's, something like this, I think there might be it might make this defense more convincing to the court. Because if he was having this discussion with Jim over a pint, there's no expectation of confidentiality of the stuff that you talk about in the pub, is there? I mean, I wouldn't have thought people would need to tell you explicitly, and even if they did, unless they get you to sign an NDA, still I don't think it will work. So I think we have some opportunity for Jim to say he wasn't expecting this to happen. But on Holly's grounds, I don't think Holly can utilize any of the defenses here, because she understood the information to be private, she understood the information to be price sensitive, and then she went and actually transacted on that in order to make a profit. So you see, we have a definition of inside information here that helps us as well, and of who is an insider and what being public means. And you see, you have it by your employment, or if you're a director or shareholder, you have access to the information by virtue of your employment. So if you're their accountant, even if you work for them inside the firm or you work as an external consultant, you still have this information by virtue of your employment. All right, let's see what is the penalty. An individual guilty of insider trading shall be liable on a summary conviction to a fine not exceeding the statutory maximum or imprisonment for a term not exceeding 6 months or both. Or if your conviction on indictment, then it's higher. It goes up to 10 years.